In agreement with Go Cardless 2021, a statement of changes in equity is for many businesses the missing link between their income statements and their balance sheet. It provides an account of how equity moves through the business throughout the reporting period. And for this video, we will be discussing this link. A better day to everyone. Let us start with the net income of Century Pacific Food Incorporated. As shown in the table, it can be gleaned that the net income increased by 6.87%. On the other hand, the currency translation adjustment increased by 81.87%. As observed, this increase suggests that the company had benefit obligation for 2022. This means that the company's pension plan assets performed well, leading to a decrease in the company's pension liabilities, improving the company's balance sheet, and reducing future pension-related expenses. Furthermore, the appropriations in 2021 was reversed upon completion of the project in 2022. In 2022, the appropriations amounted to 8,736,038,578 pesos pertains to the 2023 capital expenditures. All of these changes in the temporary account balances affect the balances of the company's permanent equity accounts.
Moving on to the company's cumulative account balances for 2022 and 2021, as presented in the screen, it can be noticed that there have been no changes in the company's share capital, share premium, and reserves. This suggests that the company may have maintained a stable capital structure without using or without issuing new shares or purchasing shares or conducting any significant capital transactions. As a result, the share capital and share premium accounts remain unchanged. Moreover, as stated under Note 26, because there were no share options offered in the Employee Stock Purchase Plan or ESPP for purchase or subscription from the management in 2022, 2021, and 2020, thus resulting to the share-based compensation reserves balances remaining the same. On the other hand, the permanent account of currency translation adjustment was affected by the temporary adjustment, thus resulting in a 23.07% increase. Meanwhile, the unappropriated retained earnings decreased by 13.66%. On the contrary, the appropriated retained earnings increased by 188.70%. The significant increase in this account suggests that the company is setting aside a larger portion of its earnings for specific future expenses or investments. As a matter of fact, it was stated in Note 18 that on December 21, 2022, the BOD authorized to appropriate retained earnings for capital expenditures, which is expected to be completed in 2023, specifically for the construction of a new plant, corporate projects, and other projects in connection with the canned meats, sardines, and mixed business of the parent company and its subsidiaries. This account is a major contributor to the 15.63% increase in the total changes in owner's equity of Century Pacific Food Incorporated.
Moving on the Century Pacific Food Incorporated ratios, we came up with the following analysis. In 2021, the price-to-earning ratio was 22.17, which means investors are willing to pay 22.17 times the company's earning per share for its stock. In 2022, the price-to-earning ratio decreased to 18.29, indicating that the stock became relatively more affordable compared to the previous year. The price-earning ratio indicates the price investors are willing to pay for each unit of earnings generated by the company. The decreasing price-earning ratio suggests that investors may have lower expectation for future earnings growth or that the stock is undervalued. On the other hand, in 2021, the diluted EPS was 1.3192, indicating the company's earning per share, while in 2022, the diluted EPS increased to 1.4113, suggesting improved profitability on a per share basis. Diluted EPS represents the earnings per share after accounting for potential dilution from stock, options, or convertible securities. The increasing trend in diluted EPS indicates that the company's earnings are growth over time, which can be positive for investors.
As observed, the debt to equity ratio was 0.64, indicating that the company had 0.64 units of debt for every unit of equity in 2021 and increased to 0.68 in 2022, suggesting a slightly higher level of debt relative to equity. The debt to equity ratio measures the proportion of debt to equity financing used by the company. A higher debt to equity ratio may indicate that the company relies more on borrowed funds. In fact, the liability increased up to 22% from 2021 to 2022 on its short-term loans payable as the major contributor. Moving on to the CPFI's ROE. There was 22.37% in 2021, indicating that for every unit of equity invested, the company generated a return of 22.37%. In 2022, the ROE decreased to 20.08%, suggesting a slightly lower profitability relative to equity. The ROE measures the profitability of a company in relation to shareholders' equity. With those results, the decreasing ROE may indicate a decline in the company's ability to generate profits from shareholders' investments.
The last ratio was equity to asset ratio, which measures the proportion of assets financed by equity in 2021. The equity to asset ratio was 0.61, indicating that 61% of the company's assets were financed by equity. In 2022, the ratio decreased slightly to 0.60, suggesting a slightly lower proportion of assets financed by equity. A higher equity to asset ratio indicates a more conservative capital structure with a larger portion of assets funded by shareholders' equity. So, overall, the analysis of all ratios suggests that Century Pacific Food Incorporated has experienced some changes in its financial performance and position. The diluted EPS and debt to equity ratio of Century Pacific Food Incorporated showed positive signs indicating improved profitability per share. However, the increase in debt to equity ratio also suggests potential additional risk for the company. On the other hand, metrics like ROE and equity to asset ratio experience declines which can be attributed to increase in its company's debt levels. The decrease in PE ratio can be attributed to the decline in stock price and impact of inflation rate.
With all the information gathered, we came up to the following recommendation that could help the CPFI monitor its company's operation and manage the potential risks that the company may face. The first one, review capital structure. The CPFI have to make sure the need to evaluate the company's capital structure to secure it is highest for its financial necessity, assess of the worth of an individual's willingness and ability to take risks until it reach the target of managing capital shareholders value and sustain high growth. The next one, enhance investor confidence. The company have to make sure to put into a practice the essential investor relations exercise to strengthen trust and confidence in the company's outlook. The third one, which is considered shareholders' return. That means that the company have to think about the techniques such as settle up with the distribution of the company's earnings to its shareholders or an instance purchasing something again or back related to shares which could likely possible to improve price to earnings ratio. Lastly, which is the managed foreign exchange risk. The important improvement is an ongoing transition adjustment suggests that the company's financial are being strongest matches by the foreign changes.